Welcome to Mead Live. My name is Richard Thompson. I am the editorial director of Mead, and I'm delighted to be joined today by Chiradeep Deb, the managing director and head of corporate finance from Mashreq. Welcome, Chiradeep.
Thank you, Richard. It's a pleasure.
So we're going to be talking today about corporate finance, particularly providing finance to contractors in the UAE construction sector.
Sure.
Now, we have been hearing at Mead for maybe 2 years about liquidity crises, late payments causing problems for contractors, delays in projects or cancellations even of projects, creating uncertainty for contractors, and a lot of problems for anyone who's operating in the construction space, particularly regarding finance. How does that look for you from a banking perspective, lending to the contractor market? What has been the impact of lower oil prices and government cutbacks?
The lower oil prices have really seen the banking sector go through a pretty significant period of challenge. We have been at it for the last 24 to 30 months. We have got to a new normal. We believe that everything needs to be cut to size with a $50 to 60 kind of barrel per barrel price.
Is it your view that the 50 to 60, the new normal that we've been talking about, that is where we are for the next 4 or 5 years at least?
I think from conservatively speaking, that's what we should be planning ourselves for. And therefore, when you come down to the question around how have the contractors really behaved during this period, we had our period of challenges, and so effectively from a period of the past where government budgetary allocations used to really fund those infrastructure projects and the projects around the region, we have come to a point where the government has moved to the other extreme, asking for the contractors to really come up and bid along with the financing package backing them. So it's a 180-degree shift.
So a lot
right?
has changed.
So a lot has changed, of course, in this market in the last 30 months.
And is that from a bank perspective? Is it changed for the good? Does it just mean that the mathematics is more complicated, or is it actually the situation is more difficult?
I think the banks had a template that they were used to prior to 2015. And we knew exactly, as long as the contractor does this stuff right, the money will automatically flow in. It's no longer the case there. So one has to tick a few more boxes and understand a bit more into detail around the budgetary support which are financing this project, how strategic they are, whether they really will stand the test of time, and then look at the contractors in a bit more detail around the other liabilities that they carry, and whether they will be able to sustain themselves if one of their projects really don't go as per the plan.
So it's no longer just a question of contractors doing things properly. You have to carry out tighter
due diligence, absolutely.
Look into more scrutiny.
I think we are very much in that phase, and the phase is just going to get more deeper.
So that means from a balance sheet point of view, the bank has to look at the contractor balance sheet, the assets, the liabilities, the quality of the project, and from a cash flow point of view, you have to look at the quality of the paymaster.
Absolutely, you've answered it. So.
Okay,
that's exactly where we are.
And does that mean it's going to be more difficult for me as a contractor to come and access finance from Mashreq or any other bank? Or does it just mean the capital is still there, but I have to get a few more?
I think it's the latter. The capital is still there. Banks have to be in business, and therefore they have to lend, and therefore they have to take risk. So that doesn't go away. We are more than happy to consider financings, as long as we understand the underlying risk that you are carrying, and we are comfortable with the way your capital structure is organized around the risks that you carry. And that's where the different forms of alternatives and challenges that come in, which we explore.
We hear from the contractors, though, that because of the cutbacks in capital spending by government, so there's a reduction in new projects coming forward. And we also hear about late payments and problems with cash flow because clients are delaying payments or governments are delaying payments. So contractors say that they've got a major cash flow crisis or crunch underway. Is that what you see when you're...
Absolutely. And in banking terminology, we see a significant cash flow mismatch been coming in because projects need to be still delivered within the timelines that they used to be delivered in the past, probably a bit more aggressive given the pipeline of projects that are in there. But at the same time, the kind of payments, the flow, the easiness with which it's to flow into the banks in terms of the work being certified, etc., are not the most optimal. And therefore, it leads to opportunities where the contractor has to really figure out how to raise that, financing in the middle. Now,
before we come on to contractor options, what does that look like from a banker's perspective? When a contractor approaches you, or any corporate approaches you to borrow money to fund their projects, what are you looking at? What are the key things you have to sort of see when somebody approaches you for borrowing?
Okay, so let's step back a bit. This market actually offers you the ability to deal with contractors across the entire credit spectrum. So you have the local contractors who have come of age after having gained the track record and respect after having executed so many projects. And then you have the international contractors who have been in different markets, emerging markets, have come to another emerging market like the Gulf and have made make themselves count, and they are really taking the more complex projects on board. Having said that, when it comes down to the bank as to how they really differentiate, there are very clear boxes that we need to see being ticked before as a part of our screening process. So we are effectively looking at, to start with, the underlying paymaster of the sponsor risk. We are looking at the complexity of the underlying project and the track record of the contractor. So those are the basic screening.
So a contractor comes to you for financing for a specific project. One of the boxes you have to take is the paymaster.
Absolutely.
So you're looking at whether they're government or private sector.
Right, and therefore that effectively gives you a sense whether the contractor, even if it has the ability to perform, will get paid on time or not.
And who should be bringing you the information about the paymaster? Is that the obligation is on the contractor to say, here is our client, here is the information, or do you go to the paymaster for that information?
In fact, we do very closely follow what's happening in the construction sector. There are bids being announced, and we therefore know which are the contractors who are bidding for that. So the major projects are already known to the people who are interested in the sectors, especially from a financing perspective, as these are the next 10 projects which are expected to be announced and awarded, etc., etc. So there is a very close monitoring that's already done. And the paymasters at the end of the day are, if at all we are restricting ourselves to the government, oil and gas, players, etc., we know there are a handful of them, and we do know the underlying credit profile as to their payment terms. Having said that, if we are to look at the next step, and these what I just mentioned to you are the very clearly the common stuff. But what is more important is to then get into the requirements around the how do you structure these facilities. Now, bonding lines are easy to assess. You have to pretty much template-ish 5%, 10%, percentage of the project. But when it comes down to raising funding lines, that's when you start taking a bit more deeper dive into the balance sheet, and that's where the international contractors obviously score a bit higher.
So the first thing you look at when somebody is asking for finance, you look at the paymaster for the project. The second thing is you look at the project itself, complexity, the technical challenge, deliverability. You also then look at the order book for a contractor. What's their pipeline?
That's a part of my more deep dive exercise, where if I am to look at, other than the fact that he has the company has the credit, has the expertise to undertake that project, then we move to the next step, is to figure out if at all the financing requirement is around financing the project. What is the kind of balance sheet depth that they do have? So there you get into the stickiness of the revenues, their order book position, their in fact on a slightly on a negative sense. But if there has been any claims on their guarantees in the past, how have they honored that?
Okay. So you're looking at the assets and liabilities.
We are looking at the assets and liabilities.
On their balance sheets.
And there we find the international contractors to a large extent having that extra edge.
So you're saying that not all contractors are the same. There is a spectrum of contractors, local, international. What are the differences between local and international?
Sure. So there is no, as they say, there is no one size that fits all on this. So everybody has to be figured out on a pretty much a tailor-made solution. But what an international contractor brings to the table, which a local contractor today doesn't have, but hopefully will get there, is the diversity of revenues, the fact that they are having a far more deeper balance sheet, probably much more capitalized. The construction, just pure contracting and construction probably being just one of their activities. There is a lot of concession-driven revenues, which is a part of the balance sheet, which gives you a sense that there is a long-term visibility of revenues coming in. It's not necessarily only on the back of order book.
So international contractors, they have the advantage of a balance sheet that belongs to a global entity rather than just the local.
That's absolutely, and typically, these international contractors do have an ability to provide you that balance sheet recourse for projects which are undertaken there. Having said that, there have been certain shifts that we have seen in the market over the last few years, without really taking names, we have seen some of the international contractors actually gravitating towards a model which does away with reliance on their central treasury at the head office and seeking funding from the regional market. And the reason why they're able to do that is because they have been operating in this market for a decade or so. They have a track record of projects that they have executed very successfully. Banks know them. There is a relationship out there, and banks like us then do take that bold step of providing them funded facilities on a medium-term basis for on the back of certain projects that they are executing in this region.
So from a lender's perspective, does that count as lending to a local entity, or is it still an international?
Well, your borrower could be still a local entity, but you have a recourse to the global balance sheet. That's where it comes down to.
And do you balance your risk profile between international and local? Each will have a different risk allocation, I presume.
There is clearly a model. We have been in the contracting business for more than 2 decades now, and we really specialize in that. And there is a financing or a risk assessment model historically, which has kind of fed into itself, which gives us very clearly a demarcation between the balance sheets based on the underlying numbers. And so don't get me wrong, there are local contractors who stack up higher than some of the international contractors, right? But bottom line, yes, there is a pricing differential that comes in based on the underlying risk profile that we look at. Having said that, it's not about that we would only go in for the international contractors. There are lots of local contractors out there who have really mastered certain areas, and we are more than happy to have almost equivalent lines open to them.
One of the trends we have seen, or one of the changes that we have seen in the last couple of years following the fall in oil prices, has been a reduction in some international contractors in this market. Does that, from Mashreq's point of view, do you envisage the market changing, your borrower market changing over the next few years with greater emphasis on local companies?
I would say there was a phase between 2010 and 13. There was a lot of weeding out of some of the international contractors who probably thought that it's not really sustainable to continue in this market because the projects had kind of dwindled. Some of the international contractors who walked away during that period are actually returning back because there is a expectation that more and more infrastructure projects are going to be funded by the government, and therefore they stand a good chance. I would say the local contractors have very well used that phase where they have really upped their ante in order to position themselves at the top end, and some of them have taken in the same breath. Some of them have taken risks which were beyond their ability to sustain, and therefore we have again seen certain names which have really not sustained its state that they were in, say 3 years back, and have had to go through some mergers and acquisitions and a sale of stake in order to come back to track. So we had a pretty much a mixed bag, but yes, from experience, every local contractors have gained, and they have now a fresh set of challenges to deal with, given the the liquidity and the new financing models that are coming in. So that's pretty much.
Okay, excellent. Well, thank you. Contractors are increasingly being asked to bring finance with them. What are the options for companies who are needing finance and who are being asked to bring finance? What do they do? Do they just carry on going to the bank as normal, or do they have other options?
You're absolutely right, and this is a trend which started in the last couple of years, where the governments who previously used to fund out of their budgetary allocation, given what's happening to the oil prices and the need for them to fund the deficit somewhere else, have for some of the new projects that they are giving out on for a bid, have asked the contractors to come along with a financing package. Now, again, that's where the $billion question is that. When you look at a contractor balance sheet, it's heavy on contingent liabilities, debt which actually don't see on the balance sheet, and to top it, most of the revenues are already encumbered, right? Because it's given around across the for the bonding lines. So you have pretty much a balance sheet which has a certain level of capitalization, but a lot of contingent and top lines already given away to certain banks. So for somebody to raise financing and for a bank to provide financing, it's pretty much on a subordinate basis to kind of start with. So it's definitely a challenge. And if you really load up these contractors with debt, even if you were to do it, then you come across a point where you are reducing their financial flexibility, gradually, and therefore over a period of time, unless they adequately keep on capitalizing themselves, they lose the financial flexibility to bid for the next one. So it's not really a win-win situation for the government or the contractors, because obviously the government, as a result of a few such successes, would hamper the ability of the next bid coming in.
So in terms of models that they can use, one that I hear a lot about is raising equity, going to the capital markets, to whether it's through an IPO or some sort of equity share sale.
Some of them have, the international contractors have done that, some of the local contractors have done that, but we have seen the kind of swings that they have gone through in the equity capital markets. I won't say it's something which is the most viable option at this point of time. One would still want to look at the way to stay within the debt framework, but obviously within the debt framework, the banks are not the only solution in town. Right now, you would have probably heard a lot around the project finance market, where the projects which have been completed have reached a certain level of sustainability, have been taken out through the capital markets issuances, and this effectively released some capital back for the banks to go out and deploy. Having made that.
So this
point,
is talking about project finance. Now, once you get into the operating phase of a project,
that's
you can
right.
refinance at a different
set of investors altogether.
Yeah.
Absolutely.
But in terms of contractor finance, bond issuance isn't that common, is it?
It's not. And it is that much more, therefore, difficult for contractors to raise financing in the capital markets. Now, the way I look at it, and maybe I'm a bit ahead of time, there is very close linkage between the contractors and the project, right? At the end of the day, you're talking about a construction phase where there is a project risk. Once the project gets over, the biggest risk element has already moved out. Banks in there typically feel or rather have derived the comfort to take on this project finance risk and therefore can assess the contractors very well. However, at the same time, there is a lot of liquidity which is available at the shorter end of the curve, not necessarily for the longer 20-25 years.
Okay.
If you see the project finance market, at some point of time there were at least 40 international banks who were operating in this part of the world. I'm talking pre-crisis days. You look at the number of international banks operating out here on the project finance. It has definitely halved, if not more. The local banks are more like episodical support on project finance because they don't have those 20-25 years of funding at very cheap cost. So here is a solution which, as I said, I might be ahead of time, but might work. You typically have long-term liquidity available with the pension funds of the world, the insurance companies, etc., who are always looking at long-dated assets. They also do have this challenge where a part of their portfolio, given what their objective is, a part of their portfolio should be longer dated, and infra funds, etc. They do not get enough assets in this part of the world in order to invest those long-term. So they have to take those refinancing risks, more often. I believe that there will be a natural fit if they were to given a piece of this project finance.
Okay, so you're talking about some kind of blend with short-term lending from the local banks and long-term lending from the international banks in some kind of blended structure. Is that PPP that you're talking about?
It could be a potential PPP model, but what I'm trying to bring in is the capital market flavor of it from day one into these projects, where I'm even going a step further. The funding is available through these entities or through these funds or pension funds or insurance companies on day one. Through, obviously, you need to put a framework in place. However, the project risk period is pretty much guaranteed by the banks who understand contractor financing and project finance together. So effectively, the funding is available. So there is a level of an equity put in. There is a level of debt funding which is arranged on a long-term basis. However, the risk allocation keeps on differing.
Yeah.
So say it's a 5-year project or a 4-year project. So there's a set of construction kind of a guarantors, like who are the banks who understand the project finance risk and who understands the construction, how to manage the contractors, who are responsible for putting a framework under which they feel comfortable guaranteeing that exposure of during the construction period. Once the construction is over and it reaches a certain level of milestone, the construction guarantee from the banks automatically fall off, and the project then continues.
So are you talking about the borrower, the contractor that borrows at the start of the project is part of a wider group, a special purpose vehicle company?
Absolutely.
That has the operator involved, perhaps the owner,
Absolutely.
some other players, and so they're borrowing against the full life cycle, but the financing will change at various stages in the project life cycle.
Absolutely. The risk keeps on moving to different participants as the project life continues.
So what does that mean if we compare that model? So that's something that doesn't exist very commonly today. Today, a contractor will come to you and ask for finance to provide cash flow during the construction phase, and that's a 3 or a 4 or a 5-year loan. And then the operator might have a different funding model. What has to change from what we have today to this model that you are talking about, where you have a special purpose vehicle looking for a 25-year or a 30-year finance?
I think what has to change very clearly is the widening of the market participants in a financing of this sort. So first of all, from the provider of capital perspective, there has to be laws and regulations which needs to be put in place in order to get the people who own the long-term funding to have the ability to put in money out here. Today, I believe that a lot of the state-owned pension funds and the insurance companies out here outsource their fund management to global securities firms who then invest on their behalf, right? If even a certain percentage of that is directed to be put into the local economy, and a framework created, it opens up a different pocket of liquidity altogether. So that is one. The second aspect is, and if you can do that, and the second aspect which I was coming to was if you can bring that currency twist, which effectively moves from having dollar denominated to local currency project financing. For example, if it's a financing of a road project where effectively, and that's where your PPP comes in, where your toll proceeds are typically the economic payback on that. It doesn't really need to be a dollarized kind of a funding. It can be dirham, right? And it can be the local currency, in other words. And therefore, there can be a lot of participation of these funding from day one, and the banks are comfortable taking and managing that risk during that period. They step in and they said, we guarantee the such a construction and such a project to be completed within a certain period of time, and then the payback is and XYZ. So there is a lot more that can be done on that basis, and not necessarily only leading to infrastructure like the healthcare, the education system, etc., can also be funded, and PPP is a great model. Kuwait obviously had one of the few things that they had a head start on, and they were one of the first ones to come up with laws and regulation. Dubai, UAE, and Dubai in particular typically took to it in 2015, and I'm sure some of the noises being made around financing some of the rail projects on a PPP basis, or rather the metro projects on a PPP basis.
PPP has worked in this region in the electricity sector.
That's right, electricity and water.
And that's attractive to, we have international institutions lending or buying bonds in companies that are developers of electricity projects. But the commercial model for those projects is you have a guaranteed revenue stream, and then you also have a sovereign feedstock supplier, so you have a guaranteed materials or input price. When you go outside of the electricity sector, you talked about road tolling, but in hospitals, schools, real estate, the commercial model is more complicated, and we haven't got a track record in this region.
We haven't at all.
So, are we close to moving to these longer-term financing structures?
I'm honestly, I'm not an authority on that subject, but if at all something were to happen on that front, and I know that the framework has been passed in 2015 for putting up the regulations around that. The first few projects outside the electricity and water, as you rightly said, are being kind of tendered out on a PPP basis. We would want to see how it typically sees a kind of attraction, or it gathers traction in the market. And I do believe that with the kind of diversity of projects that we are coming up with, you may not be very far away from having the first or the second or the third education project being financed. There was one on the education side which was done in Abu Dhabi in pre-crisis again in 2007. One of the universities was financed, but again, you as you rightly said, there was a offtake from the government, and as it was an availability based kind of a PPP model. But if we kind of move away from that into the private sector, that would be a great development, and I don't see that we are very far away from that.
So I can see from international investor point of view, the opportunity to have more investments or more assets in this region is quite exciting, and I can see why they would look at longer term opportunities. But for local banks, what's in it for them? If you're basically, it's the opportunity to spread the risk a bit with other institutions. What?
I think for the local banks, we do want to be very much a part of the development within the country, and play a role, a very important role in being a part of all the landmark developments that are coming out here. We, as Mashreq, we have always been at the forefront of it. However, we did realize that from a project finance perspective, and especially in the electricity and water area, the needs of these projects from a funding perspective have been really long dated, and therefore the local banks, while they would like to support, for some reason or the other, they have always found it difficult to take those 20-25 years liability profile. And to that extent, dollarized funding becomes a challenge. And given what's happening in the region, there has always been skepticism around PEG, DPEG, etc. And then we don't want to really open our balance sheet to that risk. Okay. Local currency funding for project finance is something where we do believe that, if at all, that can be somehow be bought into the project finance structure.
So that is quite interesting. How developed are the local currency markets for project finance?
Honestly, there is none. We have tried to provide that as a solution, because we do genuinely feel that as a bank we should supporting these projects, but we have not been able to get a local currency tranche in. And the reason why we have not been able to do that is plain and simple, because those projects, rightfully from the sponsor perspective, are all dollarized, right? The imports are dollarized, the PPAs are dollarized, etc. So there is little reason for them, and as long as the Eastern banks, Far Eastern banks, are willing to support them with cheap liquidity, they don't really need to get into dirham. But I'm just talking about broadening the entire project finance space, and if there are more opportunities coming in from a dirham perspective, we can easily go 10, 12, 15 years, as long as the structure makes sense. And I'm sure there are a lot of other banks who could probably think exactly the same way, because that's our natural currency.
And do you see local currency debt markets developing?
I have seen that in Saudi Arabia. It has developed, and some of the project finance sponsors have actually raised Saudi Riyal liquidity. And they have also raised international liquidity, but it's a good trend to have.
In the UAE?
In the UAE, unfortunately, we have not had any form of local currency debt market as of now. But as I said, for any real economy to be on a sustainable basis, there has to be a debt economy in its own currency, right? Or a debt market in its own currency. And I think it's just a matter of time that's going to open up.
So I suppose to encourage the development of local currency debt markets, we need borrowers coming to the market with propositions that
absolutely
banks can buy.
So the way it works is clear. The borrowers today, especially when you are at the middle part of the credit spectrum, right? So I'm not talking about the GREs who typically have access to the capital markets, assuming that they are rated, or even if they are not rated, they have a profile which kind of sits well with the investors. If you take them out from the equation, then there is a huge band of corporates out here who are probably already there as far as transparency, governance, etc. are concerned. They are at the top end of the banks lending spectrum, but they are totally dependent on bank financing, right? For them to really graduate, they are always looking at alternative sources of funding, so that they can reduce their reliance on one single avenue. All they need to do is to make sure that they come up with a story where they can effectively position their credit profile to a set of investors who can potentially give them a dirham liquidity for a longish period of time. It's just that today, whatever local currency bond market is out there are pretty much the banks who are the same players. So it moves from the loan book to the bond or the sukuk book. That is not really a bond market. You need certain institutional investors to come in and say, so the private money through the funds or the pension funds or the insurance or the infra funds, etc., who can raise dirham money could potentially then invest into these.
So quite a lot of pieces have to be put in place.
Absolutely.
People need to acquire ratings. There needs to be an opening up of the books. Paper needs to be brought to the market.
And you have a local currency rating market. So there are steps being taken towards that. So once you have that in place, you can also standardize pretty much the risk profile.
One final area that we've heard a lot about in the past 12, 24 months is export credit agency funding. So particularly for international contractors being asked to provide finance for a project, their home government might underwrite a project. Is that something that you think is important?
That has actually picked up steam in a big way over the last, I would say, 36 to 48 months, and we have, and it would become more and more important and prominent going forward. Two reasons. One, I guess, due to softness of in the economies in the developed markets. The ECAs from some of the European countries are more keen to support their homegrown champions into these markets, and therefore the ECA financing is available as a part of it.
Do you see most of that coming from
through the contractors
from Europe for the contract, or do you think the Chinese are going to be major players?
So
there?
you have the Chinese EXIM, you have the Korean EXIM, you have the European EXIMs, and from Italy, France, etc. And UK has been extremely competitive, and it's clearly fits in very well. The only it's not quick as sponsors would like to have, or as the other participants in the structure would want them to be, but it's definitely worth spending that time, because the kind of soft funding rates that they come up with definitely makes it worth its while. To a large extent, these ECAs have been limited to the mega projects and strategic projects, but we also heard that a lot of interest is being generated as some of the private sector projects have been able to secure some ECA funding. It may be a small piece, it may not be the biggest piece and sits very well with the commercial tranche, but there have been certain ECAs, depending on the import component, who have been able to rope in the ECAs.
So we've seen ECAs
getting into the private sector.
Infrastructure side.
Absolutely.
And you're now beginning to see early signs in private sector projects, and do you think that will develop?
I think that if at all the right steps have been taken, and there has been few successes, it would catch up.
And what will that mean for banks like Mashreq?
It would mean for a bank like Mashreq. Honestly, it's not. It doesn't come naturally to us. There are a lot of international European banks who operate in this region who actually advise on such ECA financing, because they have done that in their home markets, right? So they are definitely at a pole position. From a Mashreq perspective, we are, and any regional bank for that matter, ECA, you can never match an ECA funding, right? However, just thinking a bit forward. The new Basel III and the IFRS requirements are coming in the banking system, where capital will come at a premium, right? And with these ECA financing or the ECA wraps, they give you certain relaxation on capital. So it all remains to be seen how difficult the capital would be, or will it come at a premium going forward as the banks evolve. And whether they will be seeking capital relief as a result of lending into these structures, and therefore are willing to take little less return, but on the other hand gain on the capital side. So it's an equation which is always evolving. For all you know, you may be surprised to see some local banks really started to love ECA financing over a period of time. So the jury is out.
So one of the things we have seen over the past couple of years from the fall in oil prices has been a drop in government deposits at the banks. So that has reduced the capital requirements, the capital availability within the banks. And we've also seen a reduction in credit growth. People are borrowing less. So both of those affect bank profitability and bank capital volumes. Does that mean we've got a liquidity shortage?
I want to answer this question in a slightly different way. Given our pedigree, we were, even in good times, not really a beneficiary of the oil money directly, lying in our coffers, right? We are a private sector bank, and therefore we always fended for ourselves in the market. So high oil prices or low oil prices, from our deposit mix perspective, it hasn't really changed. So which is a good thing, because we were always prepared for, standing on our own feet. Having said that, in an overall banking system, yes, there has been a pretty significant shift in the deposit mix, and people have gone out and made sure that they have various liability buckets really well sorted out, and therefore the liability management has become that much more active in many institutions. On the asset side, we do believe that yes, there was a softened credit growth, but at the same time, incremental growth has happened in the banking system. It may be in single digits, barring a few institutions, but banks have kept lending. But this period was also used to weed out a lot of deadwood which was there in the credit portfolio. So to that extent, I think the banks are far more healthier today, waiting for the challenges going forward. And we do believe that with so much of spending which needs to be done over the next couple of years, especially in the UAE, we are all set to make sure, as long as the geopolitical landscape remains within control.
Always a difficult question.
Always a difficult question to answer, but we are definitely excited about the next 24 to 36 months.
Chiradeep Deb, Managing Director and Head of Corporate Finance at Mashreq, thank you very much.
Thank you very much, Richard. Thank you very much.
Thank you.